For most participants, markets appear to fail when prices fall, charts break down, indexes collapse, headlines turn red. But price collapse is not the beginning of failure. It is the visible outcome of something that already broke earlier. That earlier failure is liquidity. Liquidity is not capital. It is not money. It is not confidence. Liquidity is the ability to transact without forcing price discovery. When liquidity exists, markets absorb stress quietly. When it disappears, prices are forced to move violently to clear imbalances. Most investors misunderstand this distinction. They watch prices and assume causality. In reality, price movement is a symptom, not a trigger. Liquidity fails first. This pattern is consistent across crises. It appears in equities, credit, real estate, currencies, and derivatives. The surface narrative changes, but the structural sequence does not. Liquidity withdrawal always precedes instability. The reason this goes unnoticed is simple. Liquidity does not fail all at once. It degrades. At first, spreads widen slightly. Depth thins invisibly. Market makers quote but reduce size. Transactions still occur, but friction increases. To the untrained eye, nothing looks wrong. Prices hold. Volatility remains contained. Headlines stay optimistic. But beneath the surface, the system is already adjusting. Liquidity is created by willingness, not obligation. Market makers provide it when risk is manageable. Banks extend it when balance sheets are stable. Investors supply it when confidence exceeds uncertainty. Remove any of these conditions, and liquidity retracts. This retraction is not announced. It is not coordinated. It happens independently, participant by participant. Each actor reduces exposure slightly. Each reduction seems rational in isolation. Collectively, they hollow out the system. This is how liquidity dies quietly. Central banks are often blamed for liquidity failures, but central banks do not directly control market liquidity. They influence conditions that encourage or discourage its provision. During periods of stability, liquidity appears abundant because risk is mispriced. Participants assume exit will always be available. This assumption allows leverage to build. Leverage amplifies liquidity only as long as exits remain orderly. Once exits become uncertain, leverage reverses its effect. Positions become traps. Hedging becomes expensive. Selling becomes forced. Liquidity vanishes precisely when it is most needed. This is not accidental. It is structural. Markets are not designed to remain liquid under stress. They are designed to allocate capital efficiently under normal conditions. Stress reveals their limitations. Liquidity is also asymmetric. It is plentiful on the way up and scarce on the way down. Rising prices attract participants. Falling prices repel them. This creates a feedback loop. As prices rise, liquidity improves. As liquidity improves, leverage increases. As leverage increases, fragility accumulates. The system appears strong precisely when it is weakest. This is why liquidity failure is invisible in advance. There is no single trigger, no identifiable moment of collapse, only gradual degradation. Credit markets show this earliest. Bid-ask spreads widen. Issuance slows. Refinancing terms worsen. Equity markets follow later. Options pricing adjusts. Volatility skews steepen. Market depth declines. By the time prices react, liquidity has already left. This is why price-based indicators are lagging. They tell you what already happened, not what is forming. Liquidity is also misunderstood because it is context dependent. A market can appear liquid at one price and illiquid at another. Liquidity exists only within a narrow band of expectations. When price moves outside that band, liquidity evaporates instantly. This creates gaps, discontinuities, air pockets. These are not anomalies. They are the natural consequence. of conditional liquidity. During stable periods, this conditionality is ignored. Participants assume continuity. They assume gradual adjustment. History shows the opposite. Liquidity transitions are abrupt. What appears as a smooth curve in calm periods becomes a cliff under stress. This is why attempts to sell gradually often fail. The act of selling changes the environment. Liquidity is reflexive. The more it is needed, the less it exists. Central banks attempt to compensate for this dynamic. They inject reserves, they backstop funding markets, they signal support, but reserves are not liquidity. They are potential liquidity. Actual liquidity still depends on risk tolerance. When risk tolerance collapses, reserves sit idle. This is why central bank interventions sometimes fail to stabilize markets. They address solvency or funding, not willingness. Willingness cannot be forced. This creates a structural vulnerability. Modern markets are faster, more leveraged, and more interconnected than ever. Liquidity cycles compress. Transitions accelerate. What once unfolded over months now unfolds over days, sometimes hours. Participants trained on historical analogies underestimate this speed. They expect warning signs. They expect time to adjust. Liquidity failure offers neither. It arrives quietly, then suddenly. By the time it is visible, adjustment is already violent. This is why liquidity matters more than valuation in late cycle environments. Assets do not collapse because they are expensive. They collapse because they cannot be exited. Valuation determines how far prices move. Liquidity determines how fast. Speed is what breaks systems, and liquidity governs speed. This is the core misunderstandings that defines most losses during crises. Investors focus on narratives. Markets respond to mechanics. Liquidity is a mechanical constraint. It does not care about beliefs, forecasts, or intentions. When it disappears, the system adjusts regardless of sentiment. Understanding this changes how risk must be managed, not by predicting crashes, but by recognizing when liquidity is becoming conditional. That process has already begun. Quietly, structurally, liquidity does not disappear randomly. It withdraws in response to incentives. Every participant who provides liquidity is exposed to risk. That risk is tolerable only when outcomes are predictable. As predictability declines, liquidity provision becomes optional. And optional liquidity is unstable. This is where most models fail. Traditional risk frameworks assume continuous markets. They assume that transactions can always occur at marginally worse prices. They assume linear adjustment. Liquidity failure is nonlinear. At a certain point, price is no longer the variable that clears markets. Quantity becomes the constraint. Trades simply do not happen. This is why markets gap. This is why bids vanish. This is why prices jump instead of slide. The withdrawal of liquidity is driven by three forces: balance sheet constraints, risk model feedback, funding sensitivity. Each operates independently. Together they reinforce one another. Balance sheets are finite. Market makers cannot absorb unlimited inventory. Banks cannot warehouse risk indefinitely. During calm periods, inventory turnover is fast. Positions are hedged quickly. Exposure is recycled. When volatility rises, turnover slows. Hedging costs increase. Inventory becomes sticky. At this point, providing liquidity is no longer neutral. It becomes directional risk. Market makers respond rationally. They widen spreads. They reduce size. They step back. This is not panic. It is risk control. Risk models amplify this behavior. Modern markets are governed by quantitative frameworks. Value at risk, expected shortfall, stress limits. These models respond to volatility mechanically. As volatility increases, allowed exposure declines. This forces deleveraging. Deleveraging removes liquidity. The process is automatic. No decision is required. No opinion is involved. No forecast is made. Liquidity disappears because models say it must. Funding sensitivity adds another layer. Many positions are funded short term. Repos, margin loans, derivatives, collateral. As volatility rises, funding costs increase. Haircuts widen. Collateral requirements grow. Positions that were profitable yesterday become untenable today, not because fundamentals changed, but because financing did. This forces selling. Forced selling is not price sensitive. It is time sensitive. Assets are sold at whatever price clears. This is how liquidity failure becomes price collapse. Importantly, this does not require a macro shock. Liquidity can fail without recession, without earnings decline, without policy error. It can fail purely due to structural stress. This is why markets sometimes crash without obvious catalysts. The catalyst is internal. Liquidity also fails unevenly. Some markets lose depth faster than others. Some assets become illiquid sooner. This creates relative dislocations. Participants rotate rather than reduce risk. They sell what they can, not what they want. Liquid assets fall first. Illiquid assets follow later. This creates confusion. Observers assume that assets falling first are riskier. In reality, they are simply easier to sell. This is a critical misunderstanding. Liquidity preference dominates valuation during stress. Assets that are fundamentally sound can decline sharply. Assets that are fundamentally weak can hold temporarily. This inversion persists until liquidity fully collapses. Only then does valuation reassert itself. This is why early declines often look irrational. They are not driven by analysis. They are driven by mechanics. Another factor accelerating liquidity failure is correlation convergence. During stable periods, assets appear diversified. Correlations seem low. Risk appears distributed. Liquidity masks correlation. When liquidity contracts, correlations rise, not because assets suddenly become similar, but because they are sold simultaneously. Liquidity is the transmission mechanism. As it disappears, diversification fails. This is why portfolio construction based on historical correlations breaks down in crises. The correlations that matter are conditional. They emerge only under stress, liquidity stress. This is also why volatility spikes lag liquidity deterioration. Volatility measures price movement. Liquidity governs the ability to prevent movement. When liquidity erodes quietly, volatility remains low. When liquidity breaks, volatility explodes. By the time volatility is visible, the damage is already done. This creates a dangerous illusion. Participants assume low volatility equals low risk. They increase leverage. They sell protection. This behavior further weakens liquidity. The system becomes self-reinforcing. Calm increases fragility. Fragility increases sensitivity. Sensitivity increases the severity of adjustment. Liquidity failure is therefore not an accident. It is an emergent property of optimized systems. Optimized for efficiency, optimized for return, optimized for stability under normal conditions, not optimized for shock absorption. This is the trade-off markets make. Liquidity exists because participants believe it will continue to exist. Once that belief is questioned, liquidity retreats. Not all at once, but fast enough to matter. This is why warnings are ineffective. By the time participants agree liquidity is deteriorating, it is already gone. This is also why policy responses often lag. Central banks respond to price and volatility. Liquidity failure precedes both. Interventions arrive after the critical transition. They may stabilize funding, they may slow selling, but they cannot instantly restore willingness. Liquidity must be rebuilt. Rebuilt through confidence, pricing, and time. Time is the variable markets lack during stress. This is why liquidity crises feel sudden. They are not sudden in formation, they are sudden in recognition. Understanding this reframes market risk. The question is not what will cause the crash. The question is where liquidity is becoming conditional. That condition is spreading, not visibly, not dramatically, but structurally. Liquidity failure is not evenly distributed across the system. It concentrates first in the places where risk is least visible. These are not always the most speculative assets. They are often the most structured ones. Structured markets rely on assumptions. Assumptions about volatility, assumptions about correlation, assumptions about continuous pricing. When those assumptions hold, liquidity appears deep. When they fail, liquidity vanishes abruptly. Derivatives markets are the clearest example. Options, futures, and swaps allow exposure without ownership. They compress capital requirements, they amplify participation, but they also create dependency on hedging flows. When markets are calm, hedging is cheap. Dealers can offset exposure smoothly. Liquidity appears abundant. As volatility rises, hedging becomes expensive. Gamma exposure increases. Dealers reduce risk. This reduction removes liquidity, not because dealers want to destabilize markets, but because their models demand protection. This is why options-related flows often accelerate market moves. Small price changes trigger hedging adjustments. Hedging adjustments move prices further. Further movement triggers more adjustments. Liquidity collapses into feedback. This is structural fragility. Another area where liquidity fails early is credit. Credit markets depend on confidence more than transparency. Prices are less frequent. Trades are negotiated. During stable periods, this works. Spreads are tight. Issuance is strong. When uncertainty rises, credit liquidity disappears quietly. Quotes widen, trades slow, issuers delay. This happens before defaults rise, before earnings decline, before recession appears. Credit markets sense risk earlier than equities, because credit cannot absorb forced selling easily. Bond funds face redemptions. Redemptions force selling. Selling widens spreads. Wider spreads reduce NAVs. Lower NAVs trigger more redemptions. Liquidity spirals. This is why credit stress often precedes equity stress. Equity markets look resilient until credit breaks. When credit breaks, equity liquidity follows. Another early warning zone is funding markets. Funding is the plumbing of the system. Repos, commercial paper, swap funding. When funding markets tighten, liquidity becomes selective. Only the strongest counterparties transact freely. Others face rising costs or exclusion. This segmentation is subtle. It does not make headlines, but it matters. When funding tightens, leverage must decline. Declining leverage removes liquidity. This happens regardless of asset prices. Funding stress can exist while markets rise. This is one of the most dangerous conditions. Rising prices with tightening funding signal fragility, because leverage is being maintained artificially. When funding breaks, adjustment is violent. Another mechanism accelerating liquidity failure is regulatory constraint. Post-crisis regulation improved institutional safety. It also reduced flexibility. Capital requirements limit balance sheet expansion. Liquidity coverage ratios encourage conservatism. During stress, institutions must protect ratios. They reduce exposure. This is not discretionary. It is mandated. When many institutions respond simultaneously, liquidity evaporates. Regulation makes individual entities safer. It can make the system more brittle. This is another structural trade-off. Liquidity failure is also accelerated by passive investment flows. Passive strategies do not provide liquidity. They respond to price movement. When prices rise, inflows increase. When prices fall, outflows accelerate. This behavior amplifies trends. During calm periods, passive flows compress volatility. They smooth markets. During stress, they accelerate movement. Liquidity providers must absorb these flows. When they cannot, prices gap. This is why markets dominated by passive ownership can become unstable quickly. Ownership structure matters. Markets with concentrated ownership have fragile liquidity. Markets with diverse ownership are more resilient. Late cycle environments concentrate ownership. Capital flows to what has worked. Indexes dominate. Factor exposure aligns. This concentration reduces shock absorption. Liquidity becomes shallow beneath the surface. Another overlooked contributor to liquidity failure is speed. Modern markets operate faster than risk can be assessed. Algorithms respond to signals instantly. They withdraw liquidity before humans can react. This is not malicious. It is programmed. Speed compresses reaction time. It removes friction. Friction once slowed adjustment. Its removal accelerates instability. This is why liquidity collapses faster now than in past cycles. What once took weeks now takes hours. Participants trained on historical experience underestimate this acceleration. They expect time to respond. They expect orderly exits. Liquidity failure removes both. The illusion of control is strongest just before liquidity fails. Participants believe they can adjust exposure gradually. They believe they can hedge. When liquidity disappears, hedges become expensive or unavailable. This is when risk becomes unmanageable. Not because risk increased, but because tools failed. This is the essence of liquidity risk. It is not about loss. It is about inability to act. Another critical point is that liquidity failure feeds on itself. Once liquidity thins, price moves accelerate. Accelerated price moves increase volatility. Increased volatility further reduces liquidity. This loop continues until external intervention or internal exhaustion. Markets do not stop because valuation is reached. They stop because selling pressure is exhausted. Liquidity resets through pain. This is why liquidity crises often overshoot. Prices move beyond fundamental value, not because markets are irrational, but because liquidity must clear imbalances. Understanding this reframes market behavior. The most dangerous periods are not when liquidity is gone. They are when liquidity is assumed. Assumed liquidity encourages exposure, encourages leverage, encourages complacency. Late cycle environments are defined by this assumption. Participants extrapolate recent calm. They ignore structural stress. Liquidity quietly withdraws. By the time it is noticed, prices are already adjusting. This is why warnings fail. Liquidity does not announce itself. It disappears quietly. Liquidity failure is often mistaken for panic. This is incorrect. Panic is emotional. Liquidity failure is mechanical. Markets do not collapse because participants suddenly become afraid. They collapse because systems reach their limits. Those limits are defined by balance sheets, models, and constraints. When liquidity fails, participants are not reacting to headlines. They are reacting to margin calls, to funding costs, to risk limits. Emotion follows structure, not the other way around. This distinction matters because it explains why reassurance rarely works. When liquidity disappears, confidence cannot restore it. Statements cannot rebuild it. Narratives cannot replace it. Liquidity returns only when conditions change. Those conditions include lower leverage, wider risk premiums, restored balance sheet capacity. None of these occur instantly. They require adjustment. This is why liquidity crises unfold in phases. The first phase is denial. Markets continue to function superficially. Prices remain elevated. Volatility stays low. Participants dismiss anomalies as noise. Small funding stresses are ignored. Wider spreads are rationalized. Reduced depth is unnoticed. This phase can last longer than expected because incentives reward continuation. The second phase is realization. A catalyst appears, often minor, sometimes unrelated. Liquidity is tested. Bids thin rapidly, spreads jump, trades fail, participants attempt to exit and discover resistance. This is when price begins to move sharply, not because information changed, but because liquidity was revealed as conditional. The third phase is forced adjustment. Risk models react, leverage unwinds, selling accelerates. Liquidity disappears completely. At this point, valuation is irrelevant. Only flow matters. Prices overshoot. The fourth phase is stabilization. External intervention may occur. Policy support may arrive. Selling exhausts. Liquidity slowly returns at lower prices. This sequence repeats across cycles. The specifics differ. The structure does not. Understanding this sequence is critical because most losses occur in the transition between phase 1 and 2. That is where complacency meets constraint. Participants believe liquidity still exists. It does not. They delay action. Action becomes impossible. This is why liquidity risk is asymmetrical. Upside accrues gradually. Downside arrives suddenly. Markets reward patience during calm periods. They punish hesitation during transition. Liquidity failure also explains why diversification fails when it is most needed. Diversification assumes independent price movement. Independent price movement assumes liquidity. When liquidity contracts, independence collapses. Assets move together because they are sold together. This is not correlation risk, it is liquidation risk. Most portfolios are not designed for liquidation risk. They are designed for volatility risk. This is another mismatch. Volatility can be hedged, liquidity cannot. Liquidity is binary. It exists or it does not. Once gone, protection fails. This is why late cycle markets feel deceptive. They appear stable precisely because liquidity has not been tested. Stress tests assume scenarios. Liquidity crises violate assumptions. This creates blind spots. Another factor that accelerates liquidity failure is narrative anchoring. Participants anchor to recent experience. They believe markets will behave as they have. This belief delays response. When liquidity shifts, anchoring becomes liability. Those who act early appear wrong. Those who wait are forced. Late cycle environments punish both extremes. Early action underperforms. Late action is impossible. This creates frustration, but it is structural. Liquidity failure compresses decision windows. This compression is not visible in advance. It emerges only when thresholds are crossed. Another reason liquidity failure surprises markets is that it often begins outside the core. Peripheral markets break first. Smaller assets, niche segments, less visible instruments. These failures are ignored. They are considered isolated. But liquidity connects everything. Stress migrates inward. Peripheral weakness becomes central fragility. This migration takes time. But once it reaches the core, adjustment accelerates. This is why early warning signs are often dismissed. They appear irrelevant. They are not. They are signals. Another underappreciated dynamic is the role of expectation mismatch. Markets price continuity. Liquidity failure breaks continuity. When expectations are narrow, outcomes are extreme. Late cycle markets have narrow expectations. Participants expect stability. They expect support. They expect mean reversion. Liquidity failure violates all three. This violation forces repricing. Repricing is not gradual. It is structural. Liquidity also determines who survives stress. Participants with flexible capital endure. Participants dependent on funding fail. This creates redistribution. Assets move from leveraged hands to unleveraged ones. This is how cycles cleanse excess. Liquidity crises are not anomalies. They are reset mechanisms. They restore pricing realism. They reduce leverage. They widen risk premiums. They rebuild resilience. But the path to restoration is painful. Markets resist adjustment until they cannot. Liquidity failure removes resistance. This is why liquidity crises feel unavoidable once underway. They are, not because of destiny, but because structure dictates outcome. Understanding this shifts focus. Instead of asking what will happen, the question becomes where liquidity is most fragile. Fragility accumulates where leverage is highest, funding is shortest, ownership is concentrated, models are similar. These conditions define vulnerability. They exist today, not identically to the past, but structurally familiar. Liquidity is becoming conditional across systems, not absent. Conditional. Conditional liquidity is unstable liquidity. It functions until it does not. This is the most dangerous state. Markets appear calm, participants relax, exposure increases. Then liquidity disappears, not loudly, quietly. Liquidity failure does not announce itself. It reveals itself through absence. Absence of bids, absence of tolerance, absence of time. By the time it is visible, positioning is already misaligned. This is why markets rarely fail where fear is highest. They fail where confidence is deepest. Confidence delays adaptation. Delay increases sensitivity. Late cycle systems do not break because participants are reckless. They break because they are optimized. Optimization removes slack. Slack absorbs shocks. When slack is gone, adjustment becomes violent. This is the core trade-off markets ignore during prolonged stability. Efficiency versus resilience. Efficiency maximizes return during calm periods. Resilience determines survival during stress. Late in cycles, efficiency dominates. Capital concentrates. Strategies converge. Risk models align. This creates surface stability. But beneath the surface, flexibility erodes. When liquidity contracts, flexibility determines outcome. Those with optionality survive. Those without are forced. This is why liquidity crises feel unfair. Preparation underperforms until it matters. Exposure outperforms until it does not. Markets reward the wrong behavior until structure enforces the right one. This enforcement is not moral, it is mechanical. Liquidity does not care about conviction. It responds to balance sheets. When balance sheets are constrained, selling occurs regardless of belief. This is why narratives fail during stress. They are human tools applied to non-human systems. Markets operate on constraint, not intention. Understanding this reframes risk. Risk is not volatility. Volatility is a symptom. Risk is dependency. Dependency on liquidity, dependency on funding, dependency on alignment. Late cycle markets are dependent. They rely on continuous liquidity, stable correlations, predictable intervention. None of these are guaranteed. This does not mean collapse is imminent. It means sensitivity is elevated. Sensitivity transforms small disturbances into large outcomes. This is why timing feels impossible, because structure, not events, determines outcomes. Events only reveal what was already fragile. This is also why post-crisis explanations always sound obvious. After adjustment, structure is visible. Before adjustment, it is ignored. Markets do not hide risk. They normalize it. Normalization continues until it cannot. Then repricing occurs, quietly at first, then completely. Liquidity failure is not a failure of markets. It is a feature. It resets excess. It restores discipline. It reintroduces risk pricing. The cost is volatility. The benefit is resilience. But resilience is only built after stress, never before. This is the paradox participants struggle with. They want stability without adjustment, returns without risk, liquidity without cost. Markets do not offer this combination indefinitely. Cycles exist because trade-offs exist. Late cycle environments compress those trade-offs. They delay consequence. Delay increases magnitude. When consequence arrives, it feels sudden. In reality, it was accumulating. Liquidity failure is the moment accumulation becomes visible. Not because something broke, but because something reached its limit. Limits are not negotiable. They are structural. This is why understanding liquidity matters more than predicting direction. Direction can reverse. Liquidity cannot be summoned. When liquidity disappears, all outcomes converge. Price becomes secondary. Flow dominates. Those who recognize this early adjust quietly. Those who do not are adjusted. Markets do not punish ignorance. They punish rigidity. Flexibility is the only durable edge in late cycle environments. Flexibility in exposure. Flexibility in expectation. Flexibility in response. This does not require fear. It requires realism. Realism about how systems behave when stressed. Realism about the limits of intervention. Realism about the cost of optimization. Liquidity failure is not an anomaly. It is the mechanism through which markets rebalance. Understanding this does not predict the next event. It prepares for the next transition. Transitions are inevitable. They are not timed by calendars. They are triggered by constraint. Constraint is increasing. Not everywhere, not evenly, but structurally. This is why markets feel calm and uneasy at the same time. Calm in price, unease in depth. When depth fails, calm disappears. Not gradually, all at once. That is how liquidity works. Not emotionally, not narratively, mechanically, and mechanics always win.